Capital investment appraisal. We are going to see the example of net present value. Newport Leisure Park is considered investing 1,30,000 in a new film ride. The ride has an estimated life of 6 years at the end, which is estimated it will be 10,000. The project operating net cash flow as follows given below. The company cost of capital is given 12%. So under this net present value, we are going to find out the positive and negatives. So accept or reject criteria for net present value method. Accept the project, reject the project. Accept net present value is positive in choosing between mutual exclusive project. Accept the project with the highest NPV. NPV is negative. Advantages of net present value. It takes into account the time value of money. Profit and difficulty of profit measurements are excluded. Using cash flow emphasizes the importance of liquidity. It is easy to compare the net present value of different projects. Disadvantages. It is not easy to understand as a payback and accounting rate of return. It requires a knowledge of the company, cost of capital, which is difficult to calculate. IRR, that is the internal rate of return. Method calculates the exact rate of return which the project is expected to achieve based on the projected cash flow. It is a discounted rate which, when applied to the projected cash flow, ensure that are equal to initial capital outlay. The IRR is a discount factor which will be NPV is 0. It is an actual rate from the project taking into the account of time value of money. Next, the internal rate of return calculating it involves a trial and error process. The following is a step to be approached for the trial and error. First, you have to calculate the NPV based on the cost of capital. Within this discount factor analysis is negative. There is a two steps involved through the trial and error. Finding a discount factor which will give a positive net present value. To be more likely to achieve a positive NPV, one should use the lower discount factor. A lower cost of capital always increasing the chances of the project having a positive NPV. Once one has a negative or positive NPV based on two discount factor, then through the interpolation, the IRR can be found. This involves the use of the following formula. The internal rate of return formula R1 plus N1 into R2 minus R1 divided by N1 plus N2. That R1 is a lower rate of interest, R2 is a higher rate of interest, N1 is a positive, N2 is a positive of net present value. For example is given for calculating the rate of return under the project of net cash flow. Step 1. The net present value using the cost of capital 12% was a negative. This involves the calculating the discount rate which has given the net present value. Then accept or reject the criteria of IRR with internal rate of return method. Accept the project, reject the project. IRR greater than the cost of capital, IRR less than the cost of capital. Advantages of IRR. The main advantages of the IRR is that information it provides is a more useful understand by managers, especially non-financial managers. Disadvantages of IRR. The trial and error process of calculating the IRR can be the time consuming. However, this advantage can easily be overcome with the use of computer software. It is possible to calculate more than the two different IRR for a project. This acquires where the cash flow over the life of the project are the combined of positive and negative values. Under this circumstance, it is not easy to identify the real IRR and the method should be avoided. In certain circumstances, the IRR and the NPV can be given conflicting result. This occurs because the IRR will include the relative size of investment, and it is based on the percentage return rather than the cash value of return. In this advantage, we can find out the trial and error process for calculating the easily overcome with the using the computer software, and also acquire the cash flow over the life of the project. It is a combination of both positive and negative value. It is also ignore the real size of the investment based on the percentage given or offer in the organization. It will be depend upon the cash value of the return. Thank you.